All right, let's get right to it. You served your country, you did the hard work, and you earned your benefits. One of the best ones out there is the VA home loan. You probably used it to buy your first place, right? Zero down, no pesky mortgage insurance, and a great rate. You settled in, hung up some pictures, maybe even built a questionable-looking deck out back. Life is good. But now, life is changing. You got orders for a new duty station across the country, or your family is growing, and you need more space. The first thought most folks have is, well, I guess I have to sell my current house to use my VA loan again. It seems logical, like you only get one ticket for the ride. But what if I told you that's not always the case? What if you could keep your current home, maybe turn it into a rental property, build some long-term wealth, and still use your VA loan benefit to buy another house? It sounds a little too good to be true, doesn't it? Most people assume the VA loan is a one-shot deal. You use it, you're done. But the truth is, the program was designed by people who understood that military life means moving. It's not a one-and-done benefit. It's a tool you can use multiple times, provided you know the rules of the game. It's one of the best-kept secrets in real estate. This is what we call second-tier entitlement, and it's a game-changer for so many service members and veterans. It's the key that unlocks the door to a second home without forcing you to sell your first. Imagine this. You get new orders to move from San Diego to Norfolk. Instead of selling that beautiful house you bought in California, you rent it out. The tenant's monthly rent covers your mortgage, maybe you even make a little extra cash. Then you arrive in Norfolk and use your remaining VA loan benefit to buy another home for your family. You're now a homeowner in 2 different states. You're building equity. You're creating a passive income stream. You're providing a stable home for your family wherever the military sends you. This isn't some loophole or a complicated trick reserved for financial wizards. It's a feature of the VA loan program that's just not widely advertised. Why? Well, it's a bit more complex than your first loan, and frankly, a lot of lenders don't want to mess with the extra paperwork. They prefer straightforward, simple transactions. But doing the hard thing is what sets you apart, right? You did it in the service, and you can do it now. All it takes is a little bit of knowledge and the right guide to show you the way. So if you're facing a move and dreading the thought of selling, stick with me. We're about to break down exactly how you can become a 2-home household using the benefit you earned. So, who gets to take advantage of this awesome benefit? It's not just for a select few. The eligibility rules are pretty straightforward, but you have to check the right boxes. First and foremost, you need to be an eligible veteran or an active duty service member who meets the basic requirements for a VA loan. That means you've met the minimum service time, 90 consecutive days on active duty, or a few years in the National Guard or Reserves. If you qualified for your first VA loan, chances are you still qualify now. Your honorable service is the golden ticket, and it doesn't expire. That part is simple. Next, you must have already used your VA loan benefit at least once. This second-tier option is about using your remaining entitlement. Think of your benefit as a big bucket of water. When you bought your first house, you used some of that water, but you probably didn't use all of it. The government guarantees a certain amount of your loan, and unless you bought a mansion in Beverly Hills, there's likely some guarantee left over. The key is that your first VA loan is still active. You haven't paid it off and you haven't sold the property. You're still the proud owner of that home. Now here's a critical detail. The new home you're buying must become your primary residence. The VA loan program is designed to help you live in the home you own, not to build a portfolio of vacation properties. If you're moving because of a permanent change of station, that's a perfect scenario. You're leaving your old primary residence and need a new one at your next duty station. The government understands this is part of military life. You have to certify that you intend to occupy the new property as your home within a reasonable time, usually 60 days after closing. This is a rule you can't bend. Finally, you still have to qualify for the new loan from a lender's perspective. This means meeting the credit and income requirements, just like with any other mortgage. The lender is going to look at your debt-to-income ratio, which will now include the mortgage payment on your first home, even if you plan to have renters. They'll want to see that you can afford both payments, at least on paper. This is where having your ducks in a row is crucial. You need a steady income, a decent credit score, and a clear financial picture. If you meet these criteria, eligible service, an existing VA loan, a legitimate reason to buy a new primary residence, and the financial stability to handle it, then you are officially in the running for a second VA loan. Okay, I hear you. Entitlement, second tier, guarantee. It all sounds like government speak designed to confuse people. Let's throw out the jargon and do some simple, back-of-the-napkin math. Imagine the VA gives every eligible veteran a big invisible line of credit. Today in 2025, the maximum amount the VA will guarantee for a zero-down loan is tied to conforming loan limits, which can be over $766,550 in most parts of the country. The VA guarantees 25% of that loan amount. So, 25% of $766,550 is $191,637.50. Think of that $191,637 as your full entitlement, your total purchasing power from Uncle Sam. Now let's say a few years ago, you bought your first house for $300,000 using your VA loan. The VA guaranteed 25% of that loan, which is $75,000. To figure out how much entitlement you have left, you just do a little subtraction. You started with your full entitlement of $191,637, and you used $75,000 of it on your first house. So you subtract the amount you used from the total available. That leaves you with $116,637 in remaining entitlement. This isn't cash in your pocket, it's the amount the VA is willing to guarantee on your next loan. It's your secret stash of house buying power. So what does that remaining $116,637 in entitlement actually get you? Remember, the VA guarantees 25% of the loan. So to find out the maximum zero-down loan you can get, you multiply your remaining entitlement by 4. In our example, $116,637 times 4 is $466,548. That means you could potentially buy your next home for up to $466,548 with absolutely no money down. That's a pretty significant number, right? Suddenly, buying a nice family home near your new duty station without having to sell your old place seems a lot more realistic. The exact numbers can change based on county loan limits, but this is the basic formula. Of course, this is a simplified version. The actual calculation can get a tad more complex, especially in high-cost areas where the loan limits are higher. But don't get bogged down in the details just yet. The main takeaway is this: your VA benefit isn't a one-use coupon. It's a replenishing resource. As long as you didn't max it out on your first purchase, you have a powerful tool at your disposal. Understanding this basic math is the first step to unlocking a strategy that can help you build real wealth and provide stability for your family, no matter where your service takes you. It's not magic, it's just math. And it's math that works in your favor. Every time you move, you face the classic military dilemma. Should we rent or should we buy? Renting seems easy. You sign a lease, you pay your monthly check. When it's time to PCS again, you just pack up and go. There's no lawn to mow, no leaky faucet to fix, no stress about selling a house in a hurry. It offers flexibility, which is a huge plus in a life full of uncertainty. If you know you're only going to be stationed somewhere for a year or two, renting is often the smartest and safest financial decision. You avoid the high costs of buying and selling a home in a short period, which can eat up any equity you might build. But buying a home is about putting down roots, even if they're temporary. It's about having a place that's truly yours. You can paint the walls whatever color you want. You can build that questionable deck we talked about. You can create a stable environment for your family. More importantly, every mortgage payment you make is building equity. You're not just throwing money away on rent, you're investing in an asset that, over time, is likely to increase in value. If you plan to be at a duty station for 3 years or more, the financial argument for buying starts to look a lot stronger. The longer you stay, the more you stand to gain. This is where your second-tier VA loan entitlement becomes a massive strategic advantage. Let's say you're moving to an area where the housing market is on the rise. Rent prices are climbing. You know that in 3 or 4 years, you'll have paid a landlord tens of thousands of dollars with nothing to show for it. By using your VA benefit to buy, you lock in a fixed monthly housing cost. While your renting neighbors are getting hit with annual rent hikes, your mortgage payment stays the same. You're building equity in a rising market. Let's talk about a sneaky little gremlin called payment shock. It's a mortgage world term. The jarring, wide-eyed shock when your new monthly payment is way higher than you expected. One of the biggest dangers when buying a second home. You've done the math on the mortgage principal and interest. It looks manageable, but you forget the other costs bundled into your monthly payment. Property taxes, homeowners insurance, often called PITI, principal, interest, taxes, insurance. Here's where it gets tricky. Property taxes can vary from state to state, even county to county. Your $450,000 home in VA might have double the taxes of your $300,000 home in Texas. Same for homeowners insurance. If the house is in a hurricane zone, flood zone, or wildfire area, insurance could be sky high. Those two items can add hundreds to your monthly payment and blow a hole in your finances. Suddenly, that affordable mortgage isn't. Payment shock also comes from underestimating total housing liability. Lenders look at your total debt, which now includes the mortgage on your first home. Even with tenants lined up, many lenders only count a portion of rental income, usually 75%. That makes qualifying harder. They want to see you can handle both mortgage payments on your own, at least for a while. Think of it this way. A regular loan officer is like a general family doctor. They can handle the common cold and tell you to get some rest. A VA loan specialist is like a heart surgeon. When the situation is complex and the stakes are high, you want the person who does that one specific difficult procedure every single day. They know the nuances. They anticipate the complications. They have the experience to ensure a successful outcome. So, where do you find a pro like that? A specialist who lives and breathes this stuff? I want to introduce you to a guy named Kris McCullough. Now, I don't endorse people lightly. In my line of work, your reputation is built on the quality of your work and the trust you earn.